Hello and welcome. You're watching an NDTV Profit special. It's S&P Global has raised its outlook on India's credit rating to positive from stable. It has reaffirmed rating at BBB minus. I'm in conversation with Madan Sabnawis, Chief Economist at Bank of Baroda, and Rajni Sinha, Chief Economist at CareEdge, on the ratings, or rather the outlook change, as well as the GDP preview. India's GDP growth forecast is set to be published on Friday, and we're going to be addressing both of these. So let's have a very quick look at some of the key takeaways from the S&P ratings press release. The release talks about India's robust economic expansion and the expectations of a policy continuity. It also takes note of the change in the composition of government spending, with an increasing share now being allocated to infrastructure. So one of the key concerns that global rating agencies, including S&P, has spoken about has been the elevated fiscal deficit and a large public debt. What it says on that is that elevated fiscal deficit and a large public debt stock and interest burden persist, but the government is prioritizing ongoing consolidation efforts. It is also said that it may consider raising ratings if India's fiscal deficit narrows meaningfully, such that the net change in general government debt falls below 7% of the GDP on a structural basis. It also says that it may also consider changing ratings if it observes a sustained and substantial improvement in the central bank's monetary policy effectiveness and credibility. Now, Mr. Sabnawis, I'll quickly come to you. You have spoken about how ratings agencies might just be behind the curve, and how the change in outlook might have been long overdue, but at the moment, can we look at this as a positive and as a stepping stone to possibly a change in ratings as well in the next 24 months or so, possibly?
Absolutely, because if you look at the way in which these ratings move, you need to first get into a positive outlook before there is a consideration for changing of the rating. So while we have always believed that India's rating should have been in the A category, A plus category, but it so happens that we have been, along with a number of emerging markets, we seem to be at this baseline of BBB minus, and this is a reality which we are facing. So any step which taken by any of the rating agencies to improve this particular rating, even in terms of an outlook, is definitely positive for us. Now, see, while the government of India doesn't really borrow from the market, so therefore the government really doesn't get affected by the rating, but a number of Indian companies which are borrowing in overseas markets will find this to be a kind of a blessing, because the moment the outlook changes, I think the whole perception towards Indian borrowers will also change, and you'll be able to borrow at finer interest rates. This has, of course, been long overdue. As I mentioned in the beginning, I think we definitely require higher rating, but then we have to go according to these scales, because for all practical purposes, I think S&P and Moody's are the ones who control the overall ratings of sovereigns in the world. They're the ones which are most widely accepted. And any improvement which takes place out here is a positive, not just from the point of view of market sentiment, but also in the real sense in terms of companies borrowing from overseas markets.
Okay, and Rajni ma'am, what is your takeaway? How are you looking at the news? What are the possible implications going forward, as Mr. Sabnawis said, in terms of implications for funding cost for companies, possibly even the government, and of course any improvement in market sentiment, given that this was something that the markets were awaiting for a while now?
So, Pallavi, I would completely agree with Madan that this outlook improvement that they have highlighted was long overdue. If I look at, the way I would assess India, if we look at the broad categories, if we look at the economic pillar, India has this advantage of size, and it should get a benefit of that. The place where it loses out in economic pillar is its lower per capita income. But that's something which is going to take time, which cannot improve like in the next few years. But otherwise, if you look at the growth outlook also, India has been recording steady growth. The outlook is also positive. So things are good on the economic front. In fact, what the rating agencies have been highlighting is the concern on the fiscal front. But if you look at the S&P press release, it has very rightly highlighted that if you look at the quality of government expenditure, it has been improving. So the press note highlights as to how the government's focus on capex has improved, and that is going to result in improved growth outlook also going forward. The other very important thing which the press note highlights is the effectiveness of monetary policy in India. So if you see post-COVID, we saw that most of the developed countries that are, have a target of around 2% of inflation, we're struggling with around 8 to 9% of inflation. And even now when the inflation has come down in those countries, it's still much higher than their target level. Whereas I think India managed inflation quite well. Though it went up here also, but it still was, closer to our inflation target. And even now, with the inflation already within the target band, I would say the central bank has very well managed the monetary policy and has kind of kept inflation broadly closer to the target for now. So I think that's also another big positive which S&P has very rightly highlighted. So I think, and apart from that, of course, the political stability and institutional strength that we have been seeing for the last few years. So I feel all these factors warranted this improvement in outlook which has been done, and we could see a rating upgrade also happening eventually. And yes, like Madan highlighted, this would be beneficial as it would reduce cost of funds for Indian companies.
Okay, all right. Thanks a lot for that. That's extremely concise. And I do also want to ask you, Rajni, what is the trajectory going forward? While we have seen clear signs of fiscal consolidation from the government, a lot of these global rating agencies have continued to emphasize on public debt being higher than their comfort levels, and that's possibly stopped them from changing ratings despite the Indian economy outperforming on a whole host of other parameters. So in terms of the fiscal deficit, while we are expecting for fiscal consolidation to continue, we recently saw the RBI transfer also coming in higher than expected, working out better for possibly fiscal deficit target for the ongoing fiscal year. What are you making of the public debt trajectory? And while there are signs of some consolidation there as well, is that not a slightly more long-drawn process? A significant reduction in public debt. So how does one look at the scenario, and is that a deterrent in the next few months for rating agencies to actually change the ratings for the economy?
So absolutely, Pallavi, like you highlighted, if I look at the debt trajectory, which is at around 80 to 83% currently, it is going to take time for that to come down. So even while we are expecting the government to move towards fiscal consolidation going forward, and from the state government's front also, we can see aggregate state government fiscal deficit at less than 3% going forward, around 2.5 to 2.7%. But having said that, even if general government fiscal deficit goes down, the government debt is going to take time to come down. But the important point to note here is what is critical is what is the trajectory. Is it going down? Is it moving down? And that is something which is likely to happen going forward, because we are also expecting good GDP growth going forward. Broadly, it would be very safe to say that in the next 4-5 years, we could expect around average 7% GDP growth rate. So in that scenario with, fiscal deficit going down and good GDP growth expected, the debt to GDP ratio is expected to go down in the next few years. But yes, it is going to be a slow process. It's not going to immediately go down even to the pre-COVID levels. So that is also going to take next, I would say, 4-5 years.
Mr. Sabnavez, now coming to you, one of the key reasons for even the change in outlook and the positive commentary for the near term, even the medium term, has of course been India's strong growth, as Rajni ma'am too pointed out. But like we've seen GDP growth actually exceed expectations in all 3 quarters of the last financial year. We're of course waiting for the print for the 4th quarter. There is a chance that given the strength of high frequency indicators in that quarter too, it might continue to exceed expectations. But going forward, would it be correct to assess that structurally potential growth rate in the Indian economy has shifted upward? Is that your opinion as well? And also your expectations on the GDP print for the 4th quarter?
Actually, I would be a bit cautious when we're talking of whether our new normal is higher or lower, or is it a high level. We should remember that we have been used to growth rates in the region of 7 to 8%, in fact upwards of 8% in the past. And it is the case of saying that just before the pandemic, the growth did slow down, then we went into a negative territory, now we're emerging from it. So I wouldn't take too much of, I wouldn't be too ecstatic of the fact that we are growing at 7.5% or even 8%. In fact, I expect that for fiscal 24, we'll end up with a number of 7.9%. Because it's still much lower than our potential. Our potential is actually more in the region of 8 to 9%. So that is what we should be aiming for. Now, one interesting observation is if you actually look at our GDP growth in the 5 years prior to the pandemic and 5 years post-pandemic, the incremental GDP was over 40 lakh crores between 14 and 19. And if I look at 19 to 24, it's more in the region of around 32 or 33 lakh crores, which means there's a long distance to cover. So I think these numbers also tend to get exaggerated because of the negative effect which happened on account of COVID. So we have to be a bit cautious when we're interpreting this particular number. I think our real potential is 8 to 9%, and until we reach that 8 to 9%, we cannot really sit back. But I think that we can be very positive that we are moving from this 7 to 8 to 8 to 9%, because if we are managing this 7.5%, 8% growth, whatever number comes out finally, this is notwithstanding the fact that A, consumption is not really taken off, and B, private sector investment is limited in certain sectors. Now, assuming that both these two things turn around, and why do we think this happens? Because consumption is something which was pushed back on account of unfavorable monsoon on the rural side. On the urban side, we have seen that high inflation has kept down the real consumption. On the investment side, we have seen, except for infrastructure-oriented sectors, we have not really seen investment taking place in a big manner. Now, these two things are bound to change. We expect it to happen in the current financial year with inflation coming down. Both rural and urban demand should revive. We can actually be aspiring to something in the region of 8 to 9%. So I think 7 to 8%, what we have been talking of, has been good enough over the negative base which we have had. It sort of brought us on a stable platform, but there is a kind of an acceleration which is required. And I don't think we can keep harping on the government doing it through the capex. The government also has its own limitations. And as we were discussing this entire fiscal issue, when you try to control the fiscal deficit, the ability to spend more on capex, the ability to spend on social welfare, both cannot be achieved. We've had this fortuitous condition where we had a fiscal deficit in the region of 6.5%, 7%, where we were able to borrow a lot of money. We could meet capex as well as social welfare. But we'll have to start trimming down on both of them as we move towards 4.5% fiscal deficit ratio and probably towards 3% in the next 3-4 years. So in short, now when you're talking of the current year, which has gone by, we're looking at 7.2% for Q4, which will be an improvement over what was assumed based on the full year numbers given when GDP growth was at 7.6%. Overall, we're expecting something like 7.9% for fiscal 24.
Okay, all right. So that is quite a tightrope for the government to walk on, and I think all eyes are now clearly on the results and, more importantly, the next full budget for the fiscal year. Before we spend some more time talking about what we're expecting from the GDP figures that's scheduled to be published on Friday, it's time to slip into a short break, but stay tuned. We have more coming up. Hello and welcome back. I'm in conversation with Madan Sabnavis, Chief Economist at Bank of Baroda, and Rajni Sinha, Chief Economist at CareEdge. We're going to be delving a little bit into their expectations from the GDP growth print expected on Friday evening. Rajni ma'am, coming to you, what are your expectations I also want to ask you specifically about Agri GVA. Are we set for a second straight quarter of contraction there?
Pallavi, we are not expecting a contraction, but yes, we are expecting a very small growth in Agri GVA.
Okay.
Broadly, if you look at overall, we are expecting GVA growth of around 6.1% or so. Agri, like I mentioned, we are expecting a small, very small, minuscule growth because of the poor monsoon that we had last year. Industry, we are expecting growth to decelerate, but I would still say we are expecting a healthy growth. Again, the growth in construction and services sector will be strong. So broadly, that's the expectation on GVA front. As far as GDP growth number is concerned, I think there are chances that again we will see widening of this gap. So while our GDP projection is for fourth quarter is 6.4%, but I think there are high chances that like what we saw in the third quarter, if the net tax collection is high because of gross tax collection going up and subsidies going down, we could see this gap widening. And in that case, we could have a higher GDP number. But overall for the year, we are expecting GDP growth of around 7.7%. An important thing that I would like to highlight is that we are expecting that in the fourth quarter, we could see an improvement in consumption. So far, the concern has been that consumption has been weak in the economy, but we are seeing increasing trend of consumption improving, even rural consumption. Some of the indicators like two-wheeler sales or even FMCG volume growth is indicating that rural consumption is also improving. So if I look at it in terms of expenditure, we are expecting GDP consumption to start improving from the fourth quarter of FY24.
Okay, all right. Mr. Sabnavis, coming to you, while you did talk about some of the factors which are currently pushing up GDP growth, is one of them also the GDP deflator, given the WPI and CPI proportion, and given the fact that we have seen a little bit of a turnaround in WPI from what it was a year ago, do you think that a little bit of the GDP growth figure, the higher figure, is it a little bit on the higher side also because of the GDP deflator? That's something I wanted to understand.
See, the deflator is something that as long as your WPI is growing at between say 0 and 1%, I think there will be a tendency of kind of a convergence which we see between nominal and real GDP growth rates. But this, I think, is more of a base effect, and also the fact that global commodity prices have been fairly flat in the last year. And this is something which is also going to change when you're going ahead. So if we're looking at 24, 25, there will be a case of global commodity prices not really spiking up, but definitely they'll be reverting to normal. And even the WPI numbers which we have had, which have been very favorable, is something which will probably move in the upward direction. So I think that's one of the reasons why we have seen that your nominal GDP growth rate has tended to be coming in a single-digit number. Because we normally assume that if we have a 7.58% growth in real GDP, we should be having a double-digit nominal GDP growth rate. Now, that's not something which will probably happen for in this particular financial year. That is 23-24.
Okay, all right. And we also did touch upon a little bit of a revival that we're seeing in consumption, especially in rural areas. What are you making of these trends and the fact that we're seeing this revival after several quarters of poor consumption, especially in rural areas? Is there reason to believe that there's finally been a little bit of a turnaround that we can expect to persist over the next few quarters at least?
Who is this question for, Pallavi?
That's for you.
Okay. Now, actually, I have a different view from Rajni on rural demand, because our own sense which we get based on going through commentaries of various companies is that rural demand has not quite revived. It's on because of two reasons. One is of the high inflation, and second of the rural incomes which are not really grown. So I think that's the reason, and it's more a case of the company saying that we hope that in 24-25, that is the first quarter of this year, things are going to be better on the rural side. And I think a lot of these companies have actually deferred this kind of a revival to the second and third quarters. That is based on how the monsoon really fares and how it gets spread across the agricultural belts. So I think rural demand is something which has been lackluster. And as I told you, both in terms of high inflation, because we've seen rural inflation being higher than urban inflation. So that is something which has eroded the consumption part. And also the fact that the overall Kharif as well as Rabi crops, what we are hearing about the wheat crop, hasn't been as good as what one would have expected. So there is definitely a case of the farm income from the rural side being taken a backseat. Some kind of an improvement was seen more in terms of the non-agricultural rural incomes, but not really manifesting in any big way in terms of turnaround in demand. So that is something which could be a positive factor for us when we're looking at 24-25. So again, you've not really spoken about 24-25. We at Bank of Baroda are very gung-ho about growth in 24-25. Precisely because we think the rural demand, urban demand, low inflation, that is going to work, and we can actually be looking at a number probably in about 7.5% for 24-25 also.
Oh, okay. All right. And that actually takes us to the last question. Rajni ma'am, I do want to understand what your reading as well of the current high frequency indicators for the ongoing quarter. Do we continue to see some kind of an uptick in terms of sequential momentum?
So, Pallavi, most of the high frequency indicators are looking good. Whether you look at PMI, manufacturing, services, or you look at two-wheeler sales, even auto sales, though for 1 month we saw, deceleration, but broadly if you see, it had been healthy, auto sales. Non-food credit uptake is also strong. Consumer sentiments are improving. So I would say GST collection has been at a high. So broadly, I would say the high frequency indicators are looking good. On a sequential basis, we are seeing improvement. So we are optimistic, like Madan highlighted. We are also optimistic on FY25 growth outlook. A few things that we need to be wary of. One would be as to what happens to global commodity prices, as that has been inching up. So, and that would have a bearing on the input cost here. So we would be watchful of that as to how that plays out, because with what kind of growth China records, what happens in terms of geopolitical scenario, because that would have a bearing on global commodity prices. So we would be watchful of that. Second very critical thing would be what happens to inflation, more specifically food inflation. While I said that, consumption, we are expecting it to improve, going forward in FY25 also, the consumption momentum should improve, but that would hinge a lot on what happens to inflation, specifically food inflation. Because food inflation still remains high at around 7 to 8%, and more so, inflation that are in some of the items like vegetables, pulses, and now there are concerns on wheat prices too. So those are the factors that would be critical, because that would have a bearing on the consumption revival too. But otherwise, we are seeing an improvement in consumer sentiments too. Data is also showing that household spending in discretionary items is also improving. So those are some of the positive signals. But these are the factors to watch out for. And another very critical factor to watch out for would be what happens to private investment. Because while a lot of factors are in favor for private investment to pick up, but it would be critical to watch if we see a meaningful pickup happening in FY25.
All right. Thank you so much for that. With that, we're completely out of time. But thank you, Mr. Sabnawis and Ms. Rajni, for taking time out for us today. Thank you for watching, and do watch out for our continuing coverage on GDP that's scheduled to be published at 5:30 on Friday.